The simplest rule in investing is the hardest to follow. Charlie Munger spent 99 years on this earth, and somewhere in the middle of all that time, he discovered something most people never learn. It wasn't about getting rich. It was about staying rich. More than that, it was about staying sane while everyone around you lost their minds. He called it his avoid crazy rule, and at 65, it might be the most important thing you'll ever hear about money. Before we go further, let's be clear about something. Nothing in this conversation is financial advice. I'm not your advisor, and you're not my client. What follows is simply an exploration of one man's philosophy, a way of thinking that shaped one of the most successful investment careers in history. What you do with your money is between you and the professionals you trust. But what you do with your thinking, that's something we can explore together. Munger didn't talk like other investors. He didn't promise 12% returns or triple-digit gains. He talked about avoiding stupidity. It is remarkable how much long-term advantage people like us have gotten, he once said, by trying to be consistently not stupid instead of trying to be very intelligent. Not stupid. Think about that for a moment. The man who helped Warren Buffett build Berkshire Hathaway into a machine worth hundreds of billions didn't focus on brilliance. He focused on not being dumb. At 65, this matters more than it ever has before. You've worked 40 years, maybe longer. You've saved, invested, worried, and planned. The money you have right now isn't just money. It's every early morning you dragged yourself out of bed. It's every argument you didn't have because you couldn't afford it. It's every vacation you postponed and every dream you funded slowly, carefully, over decades. And now you're being asked to make it last another 30 years, maybe more, while the world tries to separate you from it in 1,000 different ways. Charlie Munger understood something about human nature that most people discover too late. We don't usually fail because we're not smart enough. We fail because we do crazy things. We chase. We panic. We believe stories that sound too good to be true because we want them to be true. We make big bets when we should make small ones. We abandon discipline when everyone else seems to be getting rich without it. And the older we get, the less time we have to recover from these mistakes. Here's what most people miss. Munger's avoid crazy rule wasn't about missing opportunities. It was about seeing clearly. In the 1990s, when the entire world went mad for internet stocks, when companies with no earnings were worth billions, when every dinner party conversation turned into investment advice from people who'd never invested before, Munger and Buffett did something that looked foolish at the time. They sat still. They watched. They waited. People called them dinosaurs. People said they'd lost their edge. The money poured out of Berkshire and into technology funds that promised to double every year forever. And then it all collapsed. The people who got rich quick got poor even quicker. But Munger, he was still there, still patient, still rational, still whole. That's the rule. Avoid crazy, not once in a while, not when it's convenient. Always. Let me show you something about what crazy actually means when you're past 60. Crazy is believing you can time the market after a lifetime of evidence that you can't. Crazy is buying something because your neighbor bought it and he seems happy. Crazy is panic selling in a downturn because you watch too much news. Crazy is trying to get back what you lost in 2008 by taking twice the risk now. Crazy is believing any investment that promises safety and high returns at the same time. Crazy is thinking This time is different. Crazy is forgetting that every bubble in history felt rational to the people inside it. Munger had a phrase he used often: invert, always invert. He borrowed it from the mathematician Carl Jacobi. Instead of asking how to succeed, ask how to fail, and then avoid those things. At 65, this becomes a survival tool. You don't need to find the next Amazon. You need to avoid being the person who loses half their retirement in something stupid. Watch what happens when you shift your thinking this way. Suddenly, the game changes. You're not trying to beat the market. You're not trying to impress anyone. You're not measuring yourself against some neighbor who claims his Bitcoin went up 40%. You're simply protecting what took you 40 years to build. And in that protection, something interesting happens. You sleep better. You worry less. You stop checking your accounts every morning. The mental space that used to be filled with anxiety gets filled with something else. Peace, maybe. Clarity. Freedom. This is where Munger's philosophy becomes more than just investment strategy. It becomes a way of living. He lived in the same house for 70 years, the same house. While other wealthy men bought compounds and estates, while they collected properties like trophies, Munger stayed put. He drove a modest car. He didn't own a yacht. He didn't need to prove anything. The man could have bought anything, done anything, gone anywhere. And he chose to remain exactly where he was, not because he was cheap, because he understood something about desire and satisfaction that most people never learn. The crazy that destroys retirement accounts isn't always about investments. Sometimes it's about lifestyle. It's the boat you don't need, the second home that seemed like a dream but became a burden, the car that cost more than your first house did, the vacations that require financing, the keeping up that never ends because the people you're keeping up with are just as confused as you are. Munger looked at all of it and said no, not because he couldn't afford it, because he could see clearly that none of it would make him happier, and all of it would make him more complicated. Complexity is a trap. At 65, simplicity is power. Consider this carefully. Every financial decision you make now has two costs. There's the money cost, which is obvious, and there's the mental cost, which is often much higher. Every stock you own is something to monitor. Every property is something to maintain. Every investment strategy is something to understand and manage. The complexity compounds, and before long, you're not living in retirement. You're managing a small hedge fund, except you're doing it alone, without a team, without training, without the emotional distance that professional investors have. Munger kept his life simple because simplicity let him think clearly. And clear thinking over a lifetime beats complicated cleverness every single time. He invested in things he understood deeply. He avoided things that seemed sophisticated but were really just obscure. He said no to investment bankers who promised innovative products. He said no to leverage, to complexity, to anything that required him to be right about too many things at once. One of his favorite sayings was about the investor who got in trouble. He had a lot of IQ, but not much sense. There's a deeper pattern here. Munger's entire approach was built on humility, not the false humility that pretends to be modest while fishing for compliments. Real humility, the kind that says, I don't know everything and I can't predict the future, so I better be damn careful about what I do know and what I can control. He studied the great disasters of finance and business not to feel superior, but to understand what mistakes looked like before they became obvious. And what he found over and over was that smart people did crazy things. Long-term capital management had Nobel Prize winners on its board. Enron had the most sophisticated accounting minds in America. The housing bubble had experts everywhere explaining why prices would never fall. Intelligence doesn't protect you from crazy. Sometimes it makes the crazy more convincing because you can build better justifications for it. By the time you're 65, you should know this in your bones. You've seen booms and busts. You've watched friends make fortunes and lose them. You've seen the hot stocks become penny stocks. You've lived through enough to know that the crowd is usually wrong at the extremes, and the extremes are when the crowd is loudest and most certain. Munger knew this. He lived it, and he built his entire investment philosophy around one central truth. Surviving is more important than thriving. Let's pause here. That phrase might sound pessimistic. Surviving. It sounds like you're giving up on growth, on opportunity, on the life you imagined. But that's not what it means. What it means is that you never take a risk that could wipe you out. You never bet so much that losing would be catastrophic. You never chase a return so hard that you forget what you'd lose if you were wrong. Surviving, in Munger's world, meant staying in the game long enough to benefit from time, from patience, from the slow compounding of good decisions. He once said, "The big money is not in the buying and selling, but in the waiting." At 65, this is sacred wisdom. You don't have the time to recover from catastrophic mistakes anymore. The market might recover in 10 years, but will you? Will your lifestyle? Will your peace of mind? The math is unforgiving now. A 50% loss requires a 100% gain just to break even. And while you're waiting for that recovery, you still need to pay bills, buy groceries, live your life. The young investor can ride out the storm. You can't. Not the same way. This is why avoid crazy becomes the North Star. It's not about being timid. Munger wasn't timid. He made bold moves, huge investments, billion-dollar bets. But they were always calculated, always based on deep understanding, always structured so that if he was wrong, he wouldn't be destroyed. That's the difference between courage and recklessness. Courage acts in the face of uncertainty with preparation and thought. Recklessness acts because thinking seems too slow. Now watch what this philosophy reveals about the modern retirement landscape. Everywhere you look, someone is trying to make you feel like you're missing out. The financial media runs on fear and greed, switching between them hourly. Today's crisis, tomorrow's opportunity, this new sector you've never heard of that's about to explode, that old sector you thought was safe that's actually dying. The constant churn of information isn't designed to help you. It's designed to keep you watching, clicking, trading, worrying. And every time you act on that worry, someone makes money. Usually not you. Munger ignored almost all of it. He didn't care what CNBC said. He didn't care what the analysts projected. He read annual reports. He studied businesses. He thought deeply about what would still matter in 10 years, 20 years, 30 years. And then he did almost nothing. The avoid crazy rule in practice often meant avoiding action, because action feels like control, but it's usually just movement. And movement isn't the same as progress. This is hard for people to accept. We've been trained our whole lives to believe that doing something is better than doing nothing. But in investing, especially in retirement, doing nothing is often the smartest thing you can do. Not because you're lazy or scared, but because you've already made the important decisions. You've allocated your assets. You've diversified reasonably. You've planned for income. The structure is there. Now the work is to leave it alone, to let time do what time does, to resist the urge to tinker, to optimize, to chase the next thing. Munger understood that most investment mistakes come from action, not inaction. He watched Berkshire shareholders lose fortunes trying to trade in and out, trying to time the peaks and valleys, while the people who simply held their shares became wealthy beyond imagination. The ones who did nothing, the ones who resisted every temptation to be clever. There's something almost spiritual about this kind of discipline. It requires you to make peace with uncertainty. It requires you to accept that you can't control outcomes, only behaviors. It requires you to trust a process more than you trust your feelings. And feelings at 65 can be intense. Every downturn feels like the beginning of disaster. Every upturn feels like it might be your last chance. The emotions amplify because the stakes are real now. This isn't hypothetical wealth on a spreadsheet. This is groceries and medication and the ability to help your grandchildren. Munger dealt with this by creating systems. He didn't rely on willpower to avoid crazy. He structured his life so that crazy wasn't even an option. He didn't keep brokers on speed dial. He didn't have accounts at 10 different firms. He didn't give himself the tools to make impulsive decisions. The friction wasn't accidental. It was designed. Every barrier between impulse and action was a protection, not from the market, from himself. This might be the most practical insight in all of his philosophy. You can't trust your emotions in a crisis. None of us can. Fear is overwhelming. Greed is intoxicating. The human brain hasn't evolved to handle financial markets. We're built for immediate threats and immediate rewards, not for abstract concepts like compound interest and dollar cost averaging. So you can't fight your nature. You have to design around it. What does this look like at 65? It looks like simplicity again. It looks like automatic withdrawals, not manual decisions. It looks like portfolios that don't require daily monitoring. It looks like rules you follow regardless of how you feel. Munger had a mental checklist he ran through before every major decision, not because he doubted himself, but because he knew himself. He knew he could be seduced by a good story. He knew he could get excited about something new. He knew his own weaknesses, and he built protections against them. Let me tell you about a moment in Munger's life that illustrates everything we've been talking about. It was 1987. The stock market crashed. Not a correction, not a downturn, a crash. The Dow dropped 22% in a single day, the largest one-day percentage loss in history. Panic was universal. People who'd never worried about their investments suddenly thought the entire system was collapsing. And Munger? He was calm. Not because he had special information, not because he wasn't affected. Berkshire's stock dropped too, but he'd structured his life and his investments to survive anything. He didn't need to sell. He didn't need to panic. He could wait. And he did. Within 2 years, the market had recovered. Within 5, it was making new highs. The people who sold at the bottom, who let fear make their decisions, missed the entire recovery. The people who held on, who followed their plan, who remembered that crashes are part of investing, came out fine. Some came out better than fine because they bought when everything was cheap. But the key insight isn't about buying the dip. It's about not selling the bottom. It's about having the emotional and financial capacity to do nothing when nothing is the hardest thing to do. At 65, you need to know you have that capacity. Before the crisis comes, before the market drops 20, 30, 40%, before your account balance makes you feel sick, you need to know deeply and truly that you can survive it. Not optimistically, not in theory, actually. And the only way to know that is to structure your life so that it's true. Not too much in stocks if you can't handle volatility. Not too little if inflation will eat you alive. Not so complex that you can't understand what's happening. Not so simple that you're leaving money on the table unnecessarily. This is the art of it. Munger was a master of this balance. He took risk, but only intelligent risk. He was patient, but not passive. He was disciplined, but not rigid. He knew when to act and when to wait. And more importantly, he knew the difference. That discernment, that wisdom, that's what we're really talking about when we talk about avoiding crazy. Here's the truth no one talks about. The hardest thing about money after 60 isn't making it grow. It's keeping your sanity while it does or doesn't grow. It's managing the fear when things drop. It's managing the envy when other people seem to be doing better. It's managing the regret when you see opportunities you didn't take. It's managing all of the emotional noise that comes with having everything you've built riding on decisions you made years ago and can barely remember making. Munger managed this by focusing on what he could control and accepting what he couldn't. He could control how much debt he carried. He could control how much cash he kept. He could control his behavior, his discipline, his commitment to his principles. He couldn't control the market. He couldn't control interest rates or inflation or recessions or wars or any of the 10,000 things that affect returns. So he stopped trying. He built a fortress of good habits and sound thinking, and then he lived inside it, protected from the chaos outside. You can do the same. Not with the same amounts of money, probably. Not with the same investment opportunities. But with the same approach, the same ruthless focus on avoiding crazy, the same commitment to simplicity, the same understanding that protection matters more than perfection. Think about what crazy looks like in your own life. Maybe it's checking your portfolio every day and letting your mood be determined by numbers that fluctuate for reasons you don't control. Maybe it's listening to podcasts that promise secret strategies and hidden opportunities. Maybe it's believing you can beat the professionals at their own game with a fraction of their resources and training. Maybe it's holding on to individual stocks because you like the company, even though you'd never bet your retirement on any single thing in any other context. Crazy compounds. One small irrational decision leads to another. You buy something speculative. It goes up. You feel smart. You buy more. It goes down. You feel angry. You hold on because selling would mean admitting you were wrong. You watch it drop further. You finally sell at the bottom, and then you either swear off investing entirely, which is also crazy, or you go looking for the next thing that will make back what you lost, which is even crazier. Munger watched this pattern destroy people over and over. Smart people, educated people, people who should have known better. The antidote is always the same: rules, discipline, humility, simplicity, and an absolute non-negotiable commitment to avoiding crazy no matter what everyone else is doing, because everyone else is probably doing something crazy. That's what crowds do. They amplify emotion and minimize thinking. They reward conformity and punish caution. Right up until they don't. Right up until the music stops and everyone realizes they're holding nothing. Munger lived through enough cycles to see this happen in different forms dozens of times. Real estate bubbles, tech bubbles, commodity bubbles, financial engineering that turned toxic. Every time the pattern was the same. Something starts as a reasonable idea. People make money. More people pile in. The story gets bigger and better. Skeptics are dismissed as too old, too cautious, too stupid to see the new paradigm. And then reality intrudes. The story breaks. The losses mount. And the people who stayed away look smart, but they don't feel smart because they spent years watching everyone else get rich while they sat on the sidelines. This is the psychological price of avoiding crazy. You will miss some things. You will watch opportunities pass. You will hear stories of people who made fortunes in things you understood were risky. And you have to be okay with that. You have to value your own peace more than their stories. You have to remember that you only hear about the winners. The losers don't tell their stories at dinner parties. The people who lost everything aren't giving interviews about their brilliant strategy that didn't work. The graveyard is silent. Munger knew this. He wasn't impressed by other people's gains. He was interested in whether their gains were sustainable, whether they came from skill or luck, whether they could be repeated. Most of the time, the answer was no. Most of the time, the spectacular gains were followed by spectacular losses, and the people who made them ended up right back where they started, or worse, with nothing but stories and regret. You don't want to be those people, not at 65, not when time has become your scarcest resource and mistakes have become unrecoverable. You want to be the person who slept well through every market crisis because you knew you were protected, who never had to sell anything at the wrong time because you weren't over-leveraged, who never lost sleep wondering if some investment was about to blow up because you only held things you understood and trusted. This is freedom, real freedom, not the freedom to buy anything you want, though if you're sensible, you can probably do that too. But the freedom to not worry, the freedom to wake up and think about something other than your portfolio, the freedom to trust that you've made good decisions and now you can simply live with them. That freedom is worth more than any potential gain you might miss by being too conservative. Munger valued his mental peace above almost everything else. He structured his entire life to protect it. The investments he made, the people he worked with, the way he spent his time, all of it served this larger goal of being able to think clearly, sleep peacefully, and live without constant anxiety about money. And he was right. That peace, that clarity, that's the real wealth. The numbers in your account are just a tool to get there. So what does avoid crazy actually mean? Practically speaking, when you're 65 and trying to figure out how to make your money last, it means you start by asking what would destroy you, not inconvenience you, destroy you. What loss would be unrecoverable? What mistake would force you to change your entire life? And then you make absolutely certain those things can't happen. You structure your finances so that even in the worst-case scenario you've thought of, you're still okay. Not thriving, maybe, not living your best life, but okay, surviving, whole. From there, everything else is easier. You can take some risk because you know the foundation is solid. You can invest for growth because you know your basic needs are covered. You can even be a little adventurous with a small portion of your money because you know that if you're wrong, it won't matter. But that small portion stays small. It never becomes the bulk of your wealth. It never becomes something you're counting on. It's play money, except you're old enough now to know that play money should actually be small enough to lose without caring. Munger did this masterfully. The vast majority of Berkshire Hathaway's portfolio was in solid, understandable businesses. But he and Buffett weren't afraid to make concentrated bets when they found something they truly understood and believed in. The difference was that they did the work first. They studied, they analyzed, they thought, and even then they structured things so that being wrong wouldn't be fatal. That's the sophistication, not avoiding risk entirely, but managing it so intelligently that it stops feeling like risk and starts feeling like probability and preparation. You probably won't achieve that level of sophistication. Most professional investors don't. But you can achieve something more important. You can achieve enough understanding to avoid the biggest mistakes, enough discipline to stick to a plan, enough humility to admit what you don't know, enough patience to let time work for you instead of against you, and enough wisdom to know that at 65, enough is actually plenty. There's a beautiful simplicity to this realization. You don't have to maximize everything. You don't have to squeeze every basis point of return out of every dollar. You don't have to beat the market or impress your children or prove anything to anyone. You just have to be sensible, rational, steady, boring even. And in that boring rationality, you find something that the people chasing excitement never find: contentment. Munger achieved a level of wealth that let him do anything he wanted. And what he wanted was to read books, think about ideas, spend time with people he respected, and work on problems that interested him. The money was a tool, not a goal. It bought him time and freedom, but it didn't define him. He didn't need more. He had enough. And because he had enough, he could afford to be patient, to be selective, to avoid crazy, because he wasn't desperate to make more. This is the real lesson, not the specific investments Munger made or the exact strategies he followed, but the mindset he cultivated, the inner game he mastered, the ability to separate his self-worth from his net worth, the wisdom to know that more isn't always better, and faster isn't always smarter, and complicated isn't always sophisticated. Sometimes, most of the time, simple beats complex, slow beats fast, and enough beats more. At 65, you're closer to understanding this than you've ever been. You've lived long enough to see through the marketing, the promises, the too-good-to-be-true schemes that seemed so appealing when you were younger. You've probably made some mistakes, maybe big ones. And if you're honest, those mistakes weren't made because you weren't smart enough. They were made because you did something crazy. You chased. You panicked. You believed someone who told you what you wanted to hear. You ignored the little voice that said, "This doesn't make sense." You knew better, but you did it anyway. Munger made mistakes too. Every investor does. But his mistakes were smaller because he never bet the farm on anything. He never put himself in a position where being wrong once would be catastrophic. He built in margins of safety everywhere. That's the term he loved, margin of safety. The space between what you think will happen and what you need to happen to be okay. The bigger that space, the more room you have to be wrong and still survive. This is how you apply avoid crazy to your life right now. You look at every decision through the lens of, what if I'm wrong? Not what if I'm right, and this works out beautifully and I look brilliant. What if I'm wrong? what happens then? Can I live with it? Can I recover? If the answer is no, you don't do it. It doesn't matter how good it sounds. It doesn't matter who's recommending it. It doesn't matter what you might miss. If being wrong would break you, you walk away. This will feel like you're missing out sometimes. It will feel overly cautious. It will feel like you're not maximizing your potential. And all of that is true. In a sense, you are missing out. You are being cautious. You aren't maximizing, but you're also not going to be the person who loses everything right. When you can't afford to lose anything, you're not going to be sitting across from your spouse at 75 explaining how the money is gone. You're not going to be moving in with your kids or returning to work or cutting your lifestyle down to nothing because you did something crazy. The negative space, the things you don't do, the disasters you avoid, those are invisible victories. Nobody congratulates you for them. Nobody gives you awards for the wealth you didn't lose. But they're real. They're the foundation of everything else. And Munger understood that better than almost anyone who ever lived. His genius wasn't in what he did. It was in what he didn't do. The investments he passed on, the trends he ignored, the excitement he sat out. All of that, nothing added up to everything. Let's bring this home now. You're 65 years old, or close to it, and you're thinking about the next 20 or 30 years. You want your money to last. You want to sleep at night. You want to enjoy your life without constant worry about markets and returns and whether you made the right choices. Charlie Munger is offering you a path. It's not exciting. It won't make you rich quick, but it will keep you sane, keep you whole, and very possibly keep you wealthy enough to do everything that actually matters. The path is simple. Avoid crazy. Avoid it in your investments by refusing to chase, refusing to panic, refusing to believe in magic. Avoid it in your lifestyle by living within your means, no matter what those means are. Avoid it in your thinking by staying humble, staying curious, staying grounded in reality instead of hope. And avoid it in your behavior by building systems that protect you from yourself, by making the right choice, the easy choice, by removing the temptations that lead to mistakes. This is not a sacrifice, it's liberation. When you stop trying to beat the game and start trying to simply not lose it, everything gets lighter. The pressure lifts, the anxiety fades. You start to see clearly again, maybe for the first time in years, and in that clarity, you remember what you actually wanted in the first place. Not to be the richest person you know, not to have the highest return, just to be okay, to be comfortable, to be free to spend your time the way you want to spend it with the people you love, doing the things that matter. Munger achieved that, not because he was smarter than everyone else, though he was very smart. Not because he had better opportunities, though he had plenty, but because he was relentlessly rational about what actually mattered and ruthlessly disciplined about ignoring everything else. He avoided crazy for 99 years, and what he got in return was a life of meaning, respect, influence, and profound contentment. The money was almost beside the point. You can have your own version of that. Not with billions of dollars, not with his specific investments or his exact approach, but with his mindset, with his commitment to sanity over excitement, with his understanding that the race isn't always to the swift and the battle isn't always to the strong, but time and chance and discipline eventually favor those who simply refuse to do anything stupid. So here's what I'll leave you with. Tonight, or tomorrow morning, or whenever you have a quiet moment, Think about the crazy in your own life. Think about the investments that make you nervous, the decisions that keep you up at night, the complexity that exhausts you, the keeping up that never ends, all of it. See it clearly, and then ask yourself one simple question that Charlie Munger asked himself every single day. Is this rational? Not is it exciting? Not is everyone else doing it? Not will it make me rich? Is it rational? Is it sensible? Can I explain the logic to someone who doesn't want me to do it? Would I recommend this to my own children? If the answer to any of those is no, you have your answer. It's crazy. And crazy, no matter how attractive it looks, no matter how it's packaged, no matter who's selling it, is the one thing you cannot afford. Not at 65, not when everything you've built is riding on the decisions you make next. Munger knew this. He lived it, and he tried to teach it to anyone who would listen. Avoid crazy. 2 words. A lifetime of wisdom, your compass for every financial decision you'll make from here until the end. Simple enough to remember, hard enough to follow, true enough to save you. That's the rule. That's the path. That's the peace waiting on the other side of discipline.